I need your full attention for the next few minutes because what I am about to show you is the kind of thing that only appears on a chart right before the market stops behaving politely. Pull up a silver chart, daily, weekly. I don't care. Zoom out just enough to see what happened in mid-January 2026, and tell me you do and feel it in your stomach. That gigantic green candle on January 14th, 2026, didn't just look bullish. It erased weeks of back and forth in a single session. It swallowed the prior range like it was nothing. It closed around $92.25, and the volume wasn't a bit higher. It was roughly 4 times the 20-day norm. That isn't a normal rally. Candle. That's the kind of candle traders whisper about because it usually shows up when the market's internal wiring snaps and physical reality starts overpowering the paper game. And here's the part most people are missing. When a candle like that appears in a commodity that has been running a structural supply deficit for years, with lease rates jumping, with physical premiums detached from spot, and with the gold to silver ratio compressing into levels we haven't seen in generations, you're not looking at technical analysis, you're looking at a countdown. Now, quick note before we dive deeper. I'm running a campaign to push back against copycat channels that recycle other people's work. If you get value from what I do, support the campaign by subscribing to The Boring Currency and drop a quick comment. Even Og John AG is enough, so the algorithm knows you're really here. And if you want the daily updates, the quick posts, and my personal takes that I don't always put on YouTube, I've also created a WhatsApp channel. The link is in the description. Join it, because that's where the premium posts go, plus instant voice notes and rapid updates when the market moves fast. Alright, back to the chart, because this is where it gets serious. As you're watching this, silver is hovering around the mid-90s. And whether you're a trader, a stacker, or just someone who wants to understand what's happening, the setup I'm about to walk you through suggests $94 isn't the finish line. It may not even be halftime. It may be the launch pad. I know that sounds extreme, from $100 to $500 in 30 days. People hear that and immediately think hype, but the point of this video isn't hype. It's to show you why certain chart events, when they collide with certain market conditions, create moves that look impossible, right until they happen. So let's start with the candle itself, because most people have never seen a true God candle, and they confuse it with any big green bar. A God candle has 3 core traits. First, the body needs to dwarf the recent norm. Not by 10% or 20%, by multiples. On January 14th, silver opened near $78.42 and closed near $92.25. That's a move of roughly $13.80. Throw it in one session. The prior 20-day average range was closer to 2.64. Do the math and you're looking at a candle more than 5 times the typical size that clears the 3 times average bar by a mile. Second, volume has to explode, not above average. I'm talking 300% plus of the recent baseline. That day, reported futures volume was in the neighborhood of 947,000 contracts versus a recent average around 223,000. That's roughly 425% of normal. You don't get that from casual retail enthusiasm. That's institutions, hedgers, funds, and players who move size, and they move size when they're either terrified or very confident or both. Third, the close has to sit near the top of the day's range with minimal upper wick. On January 14th, price ran up toward $92, $94 store and settled around $92.25, a close within the top few percent of the session's travel. Little rejection, little hesitation, just relentless buying that stayed in control right into the close. Put those 3 together, massive body, massive volume, and a close near the highs, and you've got something rare. A God candle, and it's not magical, it's informational. It's the market shouting that the previous structure is breaking. Now here's where this gets even more interesting. Silver has had strong days before. It has printed big green bars in the past decade. But most of those happened in normal conditions, where overhead resistance existed, where the order book had sellers waiting, and where the paper market could manufacture supply by issuing more contracts. This candle printed in a world where those conditions are fading. Condition 1, overhead resistance is basically gone. Silver pushed into all-time high territory. That means the usual reference points disappear. There isn't a neat multi-year level where sellers are stacked. Price enters what traders call discovery mode, and discovery mode is not calm, it's not clean, it doesn't politely pull back. 2 perfect support zones so everybody gets a second chance. Discovery mode is where gaps happen, where air pockets appear, and where the market runs ahead of disbelief. Condition 2, the seller side thins out. when the majority of the open interest is held by entities that aren't trading for fun, industrial users who need metal, long-term accumulators, strategic buyers, they don't behave like day traders. They don't dump because an oscillator looks high. They are willing to hold through noise because they care about supply, not candles. That's one reason God candles often have tiny wicks. Nobody's really offering size into the move. Condition 3, the paper market's ability to print its way out gets constrained by delivery stress. And this is the part that makes people uncomfortable. If the exchange has a mountain of paper promises, but a shrinking pool of registered metal that can actually be delivered, the whole game turns into a timing problem, because the moment too many holders ask for the real thing at the same time, the system has to choose between ugly options. Cash settlement, emergency rules, forced liquidation, position limits, higher margins, trading halts, all of which scream the same message. Physical is tight, and when physical is tight, the path of least resistance for price is up. Now, I'm not telling you this to make you panic. I am telling you because the candle we saw is exactly the kind of signal that shows up before the crowd realizes the market has shifted into a different phase. And to prove that, we need to talk about the last time silver entered a true price discovery sprint. Let's go back to 1979 into 1980. Silver didn't climb. Like a staircase, it moved in phases. Phase 1 was the slow grind. From the low single digits up into the teens, it was messy and boring. Most people ignored it. Phase 2 was acceleration. It ran from the teens into the 20s and 30 seconds, and suddenly everybody started paying attention. Phase 3 was the vertical move, the kind of move that looks illegal, the kind of move where price doubles. So fast, people think the chart is broken. And in that era, the final burst was measured in days and weeks, not months. The oh wow part of the move came late. Now jump ahead to 2010 into 2011. Same idea, different numbers. There was a grind phase, then an acceleration phase, then a vertical phase that unfolded fast enough to stun even the bulls. And what often marks the transition from acceleration to vertical is, you guessed it, a monster candle on monster volume with almost no rejection, a signal that the market has entered no reference points territory. So when I look at January 14, 2026, I don't just see a green bar, I see a phase change. Now I can already hear the skeptical comment, a big candle doesn't guarantee anything. Price can reverse tomorrow. You're right. A single candle by itself is not a prophecy, but a God candle paired with certain confirming signals becomes a high probability setup. So let's stack the evidence. Start with weekly RSI. Yes, it's screaming overbought deep into the 80s, and that scares people who learn technical analysis from textbooks. But here's what those textbooks don't emphasize enough. In commodity markets during discovery phases, overbought can persist for weeks. Overbought isn't always a sell signal. Sometimes it's simply the signature of a runaway train. Now let's talk about something most people skip, the physical signals. First, lease rates. When the cost to borrow physical silver spikes, it's not a meme. It's a stress indicator. It's the market saying, metal is scarce, and if you want it now, you will pay up. In mid-January, those borrowing costs surged dramatically compared to late December levels. That kind of move tends to show up when someone needs metal urgently. To cover, to deliver, to settle, to meet an obligation. Second, premiums. If you've tried buying physical lately, you already know spot is not the real all-in price. Premiums on popular coins and even generic rounds can float well above paper spot when availability tightens. That gap is a warning sign that the paper quote is lagging physical reality. When that gap stays wide, the market has a choice. Either physical premiums collapse because supply suddenly floods the market, or the paper price rises to close the gap. Third, inventory stress. When deliverable inventories shrink while paper promises remain huge, the math starts looking uncomfortable. If claims tower over deliverable stock, the system depends on most participants not asking for delivery at the same time. That's fine until it isn't, and God candles tend to appear right when the until it isn't moment starts creeping closer. Now let me lay out a practical timeline because 500 sounds like science fiction unless you see how discovery moves actually unfold. Think of this as a 3-act story. Act 1, digestion. After a candle like January 14th, the market often pauses, not because the bull case died, but because it needs to absorb the shock. Buyers who chase the candle take a little profit, shorts regroup and try to cap price. The chart chops between levels, volatility stays high but price holds. If silver spends days holding above key zones, like the mid-80s into low 90 seconds, that's not weakness. That's the market accepting higher pricing, and acceptance is fuel. Act 2, breakout. Once the market senses that dips aren't working and sellers are scarce, it pushes. A close above a round number like $100 becomes a psychological ignition point. News headlines begin. Commentators who ignored silver start talking about it. Momentum funds trigger. Stops get hit. Shorts cover. And every short cover is a buy order. Act 3. The squeeze and the air pocket. This is where people lose their minds because price starts moving and jumps. The chart doesn't offer nice entries. It gaps, runs, pauses, then gaps again. If the market enters a zone with low prior acceptance, an air pocket, it can travel ridiculously far before it finds real resistance because there's not much supply in between, and this is where the 30 days idea comes from. In past silver sprints, the steepest part of the move happened late and fast. Now imagine that, but with a deeper deficit backdrop and broader industrial demand, and here's the sneaky part. The market will try to bait you with normal thinking right when it stops being normal. You'll see a $3 dip and people will declare the move is over. You'll see a red day and the hot takes will scream top. Then silver will rip $10 higher overnight and the same voices will pretend they saw it coming. So I want you to watch one specific thing over the next few sessions. Does price dip on low volume and rebound fast? Or does it dump on heavy volume and struggle to recover? That single difference tells you whether the big money is quietly accumulating or whether the move is actually failing. And if you want a real cliffhanger, keep an eye on delivery headlines and any sudden rule changes around margins or position limits. Those announcements don't happen when everything is fine. They happen when the exchange needs breathing room. That's why the move could overshoot what people consider reasonable. Now let me speak directly to two groups watching right now. If you're trying to trade this, understand the environment. God candle markets are brutal. They rip up and down. They stop you out and then run without you. They punish leverage. They reward patience and position sizing. If you insist on trading, go smaller than your ego wants. Respect volatility. Don't pretend you can outsmart every $8 swing. And if you're holding physical or building a longer-term position, your advantage is different. You can tolerate chaos because you're not on margin. You're not forced to sell. You can ride out pullbacks and still participate in the larger repricing if the thesis plays out. And speaking of participation, let me do something different for a second. If anyone watching this has actually improved their financial situation, paid off debt, grew savings, built a business, landed a promotion, drop a quick note in the comments. Your story helps other people stay disciplined when markets get loud. Now another quick thing. By the time you're watching this, there should already be a members-only video live. If you want one place where I've put the most important updates together, join the membership and watch that. Premium members also get deeper analysis as we go. And honestly, it's the simplest way for me to see who's really following the work. Alright, now I want to tackle the big claim. Why could this run extend far beyond $100? Because the 100 line is psychological, not structural. Industrial demand doesn't vanish just because traders feel nervous. A manufacturer doesn't stop production because an RSI reading looks high. They stop when costs force redesigns, substitution delays, or cancellations. That's demand destruction. And demand destruction historically happens at levels that shock people because it requires price to become painful enough that behavior changes. So the real question isn't, can silver hit $100? The question is, at what price does the world use less silver? Now, I'm not here to pretend I can pinpoint the exact top. Nobody can. In discovery mode, the market writes the script in real time. But I can tell you what I'm watching as the story unfolds. I'm watching whether pullbacks get bought quickly. I'm watching whether physical premiums stay stubborn. I'm watching whether lease rates remain stressed. And I am watching whether the gold to silver ratio continues to compress because that is often a sign that silver is outperforming in a metals upcycle. Now, here's a cliffhanger you should keep in the back of your mind. The most dangerous part of a silver rally is not the first breakout. It's what happens after the crowd finally believes. That's when the move becomes reflexive. Prices rise, which draws attention, which draws more money, which pushes price higher, which forces more covering, which creates more headlines, which pulls in more buyers. That feedback loop can push price far beyond what fundamentals alone would justify in the short term. And that's exactly why the last leg of these moves can look insane. So here's what I want you to do. First, don't sleepwalk through this. Whether you're bullish, bearish, or neutral, pay attention. Second, if you haven't subscribed yet, fix that right now. Subscribe to the boring currency because the next few weeks may be the kind of market where you either stay informed or you get blindsided. Third, Join the WhatsApp channel from the description if you want the fastest updates and the voice notes when something changes intraday. And fourth, answer me in the comments with one of these questions because I want to see where you are at. Do you think the January 14th God candle was the beginning of the vertical phase? Or do you think it was the peak? And if silver tags $100, what do you think comes next? A clean pullback or a runaway squeeze? Also, small creative plug mid-video. If you're interested specifically in silver-related success stories, real people, real wins, real lessons, there's another channel linked in the description. Subscribe over there too and see how others are finding ways to build wealth in this chaotic environment. And one more time, because it matters, if you've got a success story of your own, share it below. Even a few lines can spark somebody else to keep going, because whether silver goes to $120, $200 or something that sounds ridiculous today, the bigger message stays the same. Markets don't move when everyone is comfortable. They move when structure breaks, and that January 14th candle looks like a structural break. So keep your eyes open, keep your wrist controlled, keep your emotions in check, and keep watching the next candles because the next one might be even bigger than the first. If you're still watching, you already know this isn't normal. With that said, I'm John AG and this is the boring currency. If this helped you, hit subscribe, leave a like and drop your comment, even a simple Og John AG, and I'll see you in the next video.